Hello and welcome to ETF Pulse, ETF.com's vodcast. So that's a video podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com, here as always with my co-host, Nate Geraci, president of the ETF store. So let's take a look at today's Pulse rundown. It's a crazy show that we've got for you today. So first up, we're going to be talking about Trump's crypto strategic reserve. And then keeping the crypto talk going, we'll be chatting about BlackRock adding IBIT to 2 of its model portfolios. And buffer ETFs, or defined outcome ETFs, whichever you prefer to call them, are they a buy? There's some folks that are saying not really. And then to wrap up, we are going to be taking a look at the new fund, PRIV, P-R-I-V. Nate, I'm going to have to figure out how you like to call it. That is the SPDR SSGA Apollo IG Public and Private Credit ETF. I had to look at my notes for that one. It's a long name. And we're going to wrap up on just this little thing called Trump's trade war. It is causing markets to wobble. They are going absolutely crazy today, flirting with correction territory. We'll be chatting about the impact potentially on ETFs. Nate, I am really excited for today's show.
I am so happy to be here. This is one of those weeks where we just have so many excellent topics to dive into. This is going to be fun.
I know.
Some weeks are a little more slow, they're boring. This one, we have a ton of topics.
And for everyone watching, Nate and I have decided to not tell each other what we think about any of these topics. So we're going to be live reacting to each other as this goes on. But before we jump in, because we are now in an absolutely new month, we are in March. So I wanted to take a quick look at the February flows. So ETFs have pulled in nearly $111 billion in the month of February. That's despite the sell-offs that we saw at the end of the month. That means so far this year, ETFs have raked in $217.5 billion. So we are on track to make record numbers again if we continue to see ETFs pull in the same kinds of numbers in March and in April and the rest of the year as we have at least these first 2 months. Now, taking a look at the top gainers, we have SPY reclaimed its crown from VOO. And then we have VOO and QQQ to round out the top 3. Now, top losers for the month were IWM, that's the iShares Russell 2000 ETF, TLT, that's the 20+ year Treasury bond ETF from iShares, and FBTC, that's Fidelity's spot Bitcoin ETF, which is a nice way to get us right into cryptocurrency because we have Trump's crypto strategic reserve. In case you're wondering what the hell is that, not too many of us know. There's not much details that are out there, Nate. I don't know if you have more information on it, but essentially it's the fact that the United States is going to buy, sell, and hold 5 cryptocurrencies. So that's Bitcoin, Ethereum, XRP, Solana, and Cardano. So we've got some more of the more unknown ETFs in there. I think it's a terrible idea. What do you think, Nate?
Well, first of all, how do you like the idea of the government owning assets that their sole reason for existence, at least where Bitcoin started, was to try to be outside the purview of the government. It's a bit ironic.
I know. Tell us that Bitcoin is going mainstream when governments are holding it.
It's unbelievable. Here's how I think about this. Is this really necessary? Do we really need a strategic crypto reserve? And my initial thought is that I feel like we have a lot more important things to be focused on right now as a country.
Feel that needs Nate.
I know, and I think everybody knows I'm a proponent of crypto, but this isn't exactly front of mind when I think about our myriad problems out there. Now, that said, I do think crypto is going to be a big part of our future, and so I like the messaging here from the administration. I think this is the optics of the administration saying, yeah, this is important. Right? After everything that we saw from the previous administration who completely stifled the crypto industry, this is good messaging from the current administration. I'm just not sure that a strategic reserve is necessary for crypto.
Okay, but let's go a little bit beyond that, right? Because obviously the United States does hold reserves in other things, right? We do have military reserves, and even holding assets is not necessarily a bad idea for the United States government, right? But is crypto the thing that we really should be holding? Let's just look at what happened with this announcement, right? So the announcement was made via social media on Sunday, right? It was Sunday, I believe.
It was Sunday.
Yes, it was on Sunday. Crypto, or rather, I'll just talk about Bitcoin prices, immediately spiked up to, I believe, around 90,000. Bitcoin prices, and there we have that. So Bitcoin prices spiked immediately to 90,000. We've already seen Bitcoin prices essentially tumble from those highs. And I think that is entirely the problem with holding the strategic reserve in cryptocurrency. It is I think at this point in time, too volatile an asset for the United States to buy and hold at this point as a reserve, right? As a
Okay.
reserve asset. I would want some measure of consistency in pricing if we're going to be holding it as a reserve asset.
Well, first of all, I do want to mention, I thought it was pretty funny when the announcement came out. Trump posted this and he only referenced XRP, Solana, and Cardano at first. And so you had these Bitcoin maxis out there absolutely melting down, thinking that Bitcoin was not going to be a part of
No.
the strategic reserve. It was the same with Ether maxis. And then Trump sent another message after that that effectively confirmed that Bitcoin and Ether were going to be a part of it. Here's what I would say to your point on the volatility of crypto. I think Bitcoin, I can get my head around being part of a strategic reserve because Bitcoin is thought of as digital gold. And I know
Right.
you and I, we had a long conversation about this last week. I think Bitcoin still needs to prove itself over the long term that it will serve as a good store of value, similar to what we've seen out of gold. And obviously, we do have physical gold reserves. So I think if you think Bitcoin is digital gold, then I think you can make the leap and say, okay, we have physical gold reserves. We should have a digital gold reserves, right? Perfect. Um, Ethereum, I think, is a little bit more difficult. And I don't know if you saw this, Cameron Winklevoss. So one of the Winklevoss twins over at Gemini,
I like
he
saying the
said,
twins.
he said maybe you can make the case for Ether, and he said this could be like digital oil, right? So he said we have a strategic petroleum reserve, and Ether has been called digital oil. The problem from my perspective with that is that if you look at other crypto assets out there, they're in competition with Ether, right? So take Solana, for example. That platform is in direct competition with Ether. And so which one is actually digital oil? Are either of them or neither of them? And then the other problem that you get here is you effectively have the government picking and choosing winners, right?
Right.
Which I don't know that anybody wants that because if they include one crypto asset and not another, that's sort of an endorsement or I guess, explicit endorsement.
Glad you mentioned that because this might even be going a little too far afield, but I'm just going to be saying it because it almost felt a little pump and dumpy, this whole sort of announcement. I heard, and this could just be just random, social media fodder, some musings that someone had like a 50 times leveraged like Bitcoin that they bought right before this sort of announcement. It doesn't seem it would be like the US government saying we're going to buy and hold like VOO over SPY, right? It doesn't seem
Yeah.
like government should be getting involved in this kind of way. And it is, to your original point, the incredible irony that the whole point of cryptocurrency was that it was supposed to be sort of anti-government, power to the people, and to now have the US government essentially, in some ways, temporarily inflating certain cryptocurrency prices and not others. And we have thousands of different cryptocurrencies that we hold. And it's fine if the US government does want to, I think, hold cryptocurrencies in its reserve, but maybe we don't need to go out and make these announcements about picking five and letting people know how much they hold of it.
Yeah,
Because
again, no, I think that's a great point, actually. And, I mentioned that I like the optics of the administration supporting crypto because the previous administration didn't. And I don't think that's the right way to go about embracing innovation as a country. But you make an excellent point in that the way that this message came across, the optics of the message itself did feel a little pump and dumpy, right? And so you almost lose the impact of having this crypto reserve by the way the message was put out there. And maybe a better way to go about this would have been, and this was sort of how things were going, that there was word that we may get a strategic crypto reserve. I would like to see the administration engage industry stakeholders a little bit more deeply and have people who are really involved come together and talk about what makes sense. Because you had a lot of people who are very supportive of the crypto industry actually completely, they hated this entire thing.
what happened afterwards undermined the whole point of having a crypto strategic reserve. Well, we saw Bitcoin prices and crypto prices in general writ large, and not just crypto prices, but crypto ETF prices jumped on the news. And we are now seeing those same, crypto ETFs. Let's just look at IBIT, which we'll be talking about in a couple of seconds. IBIT prices now completely under pressure. It seemed that like smart money sold on the announcement and then bought back in, right? And you had this wobble in prices and also in these spot Bitcoin prices right after spot Bitcoin ETF, excuse me, prices right after this happened, which kind of begs the question, well, then why is the US government holding an asset that can lose, if it's the government holding it, trillions of dollars in value like that? And then just to gain it perhaps the next day. And then we now have to buy it back for more expensive
Yeah,
price.
and I don't have a good rebuttal to that. Again, I think I can make an intelligent argument around including Bitcoin as part of a strategic reserve if you believe it's
Yeah.
digital gold. But beyond that, I think you're exactly right. You're talking about holding essentially, high volatility technology plays.
Yeah. Well, okay. So we're going to keep the conversation going on at least Bitcoin, because BlackRock, which is the world's largest asset manager, has added IBIT, which is the world's largest spot Bitcoin ETF. And it's obviously its own spot Bitcoin ETF, IBIT, the iShares spot Bitcoin ETF, to two of its model portfolios. So just for everyone to kind of, before everyone gets super, super excited, because I actually reported on this, check out ETF.com to look at that article. I called BlackRock up about it. They were very clear with me, Nate. Two big things. One, it's only to two of the model portfolios. That's going to be the target allocations with alts and the target allocation with alts tax-aware portfolios. And the number two thing is that BlackRock's model portfolio sort of universe is about $150 billion. IBIT represents like a sliver of of that. So I know that the headlines kind of made it seem as if, IBIT is being added to in a really big way to BlackRock's model portfolios. That's not true. We'll obviously have to see what IBIT does going forward, or rather what BlackRock does going forward in terms of IBIT and its model portfolios. But this is, again, a very small step. One small step for man, one huge step for mankind, or whatever Buzz Lightyear said.
I love that our first two topics here are crypto related. I feel like I'm having an impact on ETF Pulse. Over time, we'll end up calling this Crypto Pulse. I love that. A couple of thoughts here. Not that we didn't already know that BlackRock was all in on Bitcoin, but regardless of this only being two portfolios and a small sliver, I think this is another big statement, because it's one thing for BlackRock to offer an ETF with exposure to Bitcoin. It's another thing entirely to proactively include this in
Right.
model portfolios that do have billions of dollars in assets. I think that's a big endorsement of the potential merits of owning Bitcoin in a portfolio. This is them saying, we believe that there is some value longer term to holding Bitcoin. Now, I think the messaging here is a little bit interesting to me. I actually tweeted something out yesterday where BlackRock, they wrote up this brief post on the rationale for including IBIT in the portfolios. And I have to read this to you. So they said, quote, if every millionaire in the US asked their financial advisor to get them one Bitcoin, there wouldn't be enough. Now, that wasn't their sole reason for including IBIT.
Say that again. Repeat that
Okay,
again.
so listen to this. So they said if every millionaire in the US asked their financial advisor to get them one Bitcoin, there would not be enough. So their point, they were just trying to say, hey, look, there's limited supply here. If we get enough demand, clearly that's beneficial for the price. I just thought it was interesting for them to put out a statement like that as part of this blog. And they talked about other things. I want to be clear. They talked about Bitcoin as a store of value and a hedge against the decline of the dollar and those sorts of things. But that's an interesting statement coming from BlackRock, who's typically pretty conservative.
No, you're absolutely correct. I also think that I actually felt like this was a great, and I'm not a crypto bear by any means. Of course, I think I'm a little bit more of a skeptic than you are, but I think one really big thing, and you and I have chatted about this, and we talked about this in ETF Pulse episode 2. So if you haven't listened to it yet, go back and listen to that one. We essentially talked about the fact that cryptocurrency is here. It is here to stay. And that really asset managers and brokerages and financial advisors should really be enabling people to purchase cryptocurrency if they want, and to do so in a way that is educated and smart and can actually help investor outcomes. And it is clear, at least just talking about Bitcoin, if you added Bitcoin to your portfolio, or even if you just bought it from the very beginning, it would have been a benefit to your investor portfolio. Bitcoin has, of course, been on a far more of a wild ride than if you had ever, just invested in equities, for example. We can't deny that. It is still incredibly volatile. And as you pointed out, Bitcoin still has to prove itself. It's a teenager right now, but it still is worth more today than it was at the beginning. And that is essentially all you're ever looking for your investments and your assets, to be worth more tomorrow than they were today. And on that score, I mean, if that very basic sort of smell test, Bitcoin definitely passes. And so, we have to start allowing advisors and, investors to be able to access this asset essentially. And so I thought this was a really great step. I'm really curious to see what kind of pressure this is going to apply, to some of the other asset managers and to some of the other brokerages in terms of adding, even if it's their own spot Bitcoin ETFs to their own model portfolios. I'll be curious to kind of see what happens next. But I honestly thought it was a great move. Now I'm really, really curious though to see what BlackRock does next. What portfolios, if they do decide to kind of expand this, what portfolios we're going to be seeing IBIT added to next, and what the allocations to IBIT is going to be. Because again, right now it is very, very small. And you've kind of said 1 to 5% is really your allocation sort of to cryptocurrency. I'll be curious to know what they kind of make for some of the allocations going forward, because I think that's where some of that good stuff lies. But it's nice to see sort of this mainstreaming of Bitcoin happening. First BlackRock, then the US government. Who knows? Who knows what's coming next? The Bank of England, maybe the European Central Bank starts owning Bitcoin and makes an announcement on Twitter or something like that. Who absolutely knows? Okay, so let's talk buffer ETFs. I actually have no idea how you think about buffer ETFs. So there's been some backlash lately. Buffered ETFs, you can call them defined outcome. I just prefer buffer. It's nice and easy. They've raked in over $50 billion. Some people are saying it's not really a buy. I agree with them. I hate buffered ETFs. I don't know if it's because I'm young. I don't know if it's because I just think that there's other ways for you to really mitigate risk in your portfolio. But I honestly don't necessarily think, if any of my friends were to ask me, hey, should I go out and buy buffered ETFs? I'd probably say no. They're expensive. They don't really get you a lot in terms, I think you miss out a lot in terms of gains. And again, if you really want to protect yourself to the downside of risk in your portfolio, I think there's other ways to do it that are better.
Yeah. Okay. So I don't have any problem with buffer ETFs, but I think you're right in that you have to compare them to other ways to manage a portfolio. And I think there are trade-offs here, like there are with any investment decisions that people make. And I want to give you a really crude example. So as I know you're aware, there are these 100% downside protected buffer ETFs. Have you seen these? 100%.
Yes,
okay, 100% protection to the downside. And then they're capped on the upside. Last I checked, say around 9 or 10%.
That's your trade-off, and that's your trade-off.
Right. But here's the way that I think about this, going back to what you were saying. Are there other ways to manage risk? So take this product. If the market goes down, you don't make anything, right? But you don't lose anything either, other than the fee you're paying. And to what you were saying, these are expensive. They can be 70, 80 basis points. Now, let's compare that to simply investing in a short-term treasury ETF. Well, in that ETF, I know I'm going to get 4% plus yield with microscopic fees. And so I think the question for investors is, are you sort of a bird in the hand type investor? You want to know exactly what you're getting, or do you want to spin the roulette wheel and try to get something more? So does that make sense? I mean, I know if I invest in a short-term treasury ETF, I'm getting that 4% plus pretty much no matter what. In 100% downside buffer ETF, I don't know that for sure. I might get 0 plus fees that I have to pay, or I might get, say, 9%.
And keep in mind, if you're 0 plus fees, you're actually negative. If you're really going to be like talking about it purely monetarily, you're now negative, essentially.
Okay, so now take my crude example here, and you can start expanding to all the different types of buffer products that are out there. It's the same situation in terms of the trade-offs here, because ultimately you're capping your upside and then you're mitigating some of the downside risk. But how would that look if you compare it to, say, a diversified portfolio? If you had an 80-20 portfolio or 60-40 portfolio, that's the issue here. And in my mind, it really comes down to investor behavior, because if you're an investor who you're much more likely to make emotional decisions, then I would say, well, okay, maybe it helps to have buffer ETFs, only because that'll give you some confidence that you know what your best case scenario is and your worst case scenario. And so maybe that will make you more likely to stick with a product over the long run. And so I think I can see value in that.
But I think that's where education comes in, right? I think that's where the education piece comes in to really, because we should always be checking our investor behavior, which, by the way, I bought more funds last night at 1 a.m. I don't know what it is. I just really like to buy stuff.
Wait, are you dollar cost averaging in, or
I
are you
am
just waking up
dollar cost
going, I
averaging
need
in.
IBIT?
I was dollar cost averaging in. I'm just saying, though, it always seems to happen after midnight. But I think that's where the education piece comes in to really kind of help pivot that sort of investor behavior. If you are so risk averse that you are really willing to pay a lot of money, it's a very expensive insurance policy, I think, in your portfolio. And if you are
It
someone
is, but there's,
who is
yeah. But
35,
here's the thing, there's value to that though. And that's why I'm careful to just dismiss buffer ETFs altogether, because there are people who are pre-retirees or they're in retirement. And you're right, they're effectively paying an insurance premium for this. It's a good way to think about it, but they're okay with that. And they're saying, fine, I know exactly what I'm going to get. I know that even if the market crashes X%, I'm going to have some protection. And I think that's fine. I think where I don't like these products is when they're just marketed as a direct alternative to what you were saying earlier, just a diversified portfolio that you can implement very low cost. And if you stick with that, there are studies out there. There was one I saw that Bloomberg reported on where you're going to have better returns over time just being in the well-diversified portfolio.
right. So to your point, of course, I can't dismiss any. I would say really there's very few ETFs or kind of products out there that I would just sort of dismiss outright. And buffered ETFs is no different. It does make sense in some portfolios out there. But if you are, I think, under the age of 55, or maybe even might stretch that and say 60, I don't necessarily know if buffers are your best option. And if you are under the age of 40, if my friends were to come to me and say, hey, Kristin, should I buy this buffer ETF? I'd probably say a resounding no. Or if anyone in their 20s said, I want a buffered ETFs, I would say, why?
And I would agree with you again from an investment standpoint, but it comes down to investor behavior. Can
Right.
somebody stick with a strategy over the long run? So 100%, I think we're on the same page. I just think investor behavior is such a key element here. And like we always say in the ETF space, remember, there's always, I think right now, over 50 billion invested in these
Yeah.
products. Is that right? So that's the market telling you there's demand here, regardless of what we think. There are people who are saying, yeah, I see value in these.
I'm curious to know if they maintain that. Well, I mean, who knows? We might actually see more inflows into the buffer ETFs as sort of, to your point, that sort of investor behavior says, hey, markets are really wobbly right now. And I'm liking the fact that I know that to the downside, I'm protected. But who knows? Honestly, after markets, if they do go up, we don't know what kind of year 2025 is going to be. Although generally speaking, I think a lot of people are expecting 2025 to be a pretty good year for markets. Who knows where those inflows are going to where they're going to sit? Because I think some of those investors might say, I didn't really need this product in my portfolio, and we'll see exactly how they kind of move going forward. All
Yeah,
right.
and real quick, I know we're going to move on. I'll just make the point that people look at the historical long-term returns of the stock market, and you see this average of whatever 8-9%.
Yeah.
The issue with that, as you know, is you don't just wake up and get 8 or 9% every year. There's some years like we've seen over the past couple of years where the market may be up
Yeah,
25%.
you're up 30, you're up 28, and then some you're down 16.
And that to me, that's a real issue with buffer
Yeah.
ETFs because the market doesn't just move, consistently at that
Right.
8 or 9% clip.
In
So
that linear fashion. No,
yeah.
exactly. All right. I'm gonna let you take this next one. We're gonna talk Priv. What are you calling it? I need to know what you're calling this fund.
I'm just going to go PRIV. I don't think I
Oh,
don't have an issue with a ticker. I don't think it's a great ticker
oh, boo.
for exactly what you just said, is it Priv or Prive or,
I mean, I would say Prive for private, right? But
yeah, I agree, but it doesn't really read that way.
are
So
you
I'm going
excited about it?
PRIV.
PRIV. So for everyone again who kind of already forgot what the name is, let's talk again what that name is. It is the Spider SSGA Apollo IG Public and Private Credit ETF.
That's the name for now because I think they're going to have to remove Apollo from the name last I saw.
Really?
Yeah.
Okay, go back. Give us some context into this.
Okay. So
Apollo being
this,
private equity.
yeah. So this ETF launched last Thursday, I believe. And the way that I look at this is the SEC really did not stop this ETF coming to market more so than it launched. And this ETF can hold between 10 and 35% in private credit, which private credit is obviously illiquid, right? It's called private for a reason. It doesn't trade on an open exchange, right? There's not liquidity like you see from treasuries or corporate bonds or whatever. And the context here is the SEC doesn't allow funds to own more than 15% in illiquid investments. And so the way State Street is working around this is that they're partnering with Apollo, who they're serving as like the liquidity provider here. They're standing ready to buy and sell this private credit to the for the ETF. And so because of that, you technically have liquidity, right? Apollo is, I'm going to say, transforming an illiquid asset class into an illiquid asset class. And that's how they're getting around this 15% rule.
Doesn't this concern you at all?
It
Does this
concerns
excite
me.
you? Or I should ask, does this concern or excite you? Because
Well, I'm surprised the SEC let this come to market.
right.
And yeah, the problem you have here is that, let's say if you're Apollo and State Street really needs to sell some private credit, you're having some sort of credit event, there's a market dislocation.
Mhm.
If I'm Apollo, I go, okay, great. We'll buy it at the lowest price we can possibly get it. Right? You have to sell. You need us right
You
now.
need us now. Yeah.
So I'll determine the price and you're going to like it. And so because of that, that's a conflict of interest, in my opinion.
And guess who loses?
Yeah,
Right.
it's the investor. Now, we should be clear that State Street doesn't have to use Apollo. Okay, they don't have to. They can source liquidity elsewhere. But I just think that you have the conflict of interest with Apollo, and there's ways they can mitigate that. And we should also say that State Street and Apollo, these are two very big names. These are very reputable firms. I'm not saying they're out here trying to do anything that's going to be detrimental to the investor. I'm just saying that the conflict of interest does exist. And there's also all kinds of considerations in terms of how you value holdings, right, on a day-to-day basis, how you mark the private assets or the private credit that doesn't trade. I just think there are a lot of issues here. And that's why I'm surprised the SEC let this come to market. And we kind of know that they have some concerns, because did you see this after the fact? The SEC put out this letter where they sent to all the attorneys involved with this ETF asking a bunch of questions. And I was thinking, why do we not ask these questions before the ETF came to market?
Exactly. Because I mean, I don't really, I guess because I don't want to date myself, but I don't really know of too many ETFs that the SEC has sort of let launch and then yanked back.
I almost wonder if with
it almost seems like there might be a big whoopsie, we shouldn't have really allowed.
It feels a little bit like that, and this is complete speculation on my part. I could be 100% wrong. It almost feels like this one just slipped past the goalie.
Yeah, exactly.
Like the SEC has a lot of other stuff going on, and this particular filing, it just went effective. It hit its 75-day period or whatever, and so they launched it, and then the SEC was like, whoa, wait a minute.
Yeah, wait, whoa. This is concerning to us, which either means that, again, I don't know, either force them to stop or I think some kind of change inside of the fund itself, which is probably a more likely scenario where they say, yeah, that workaround you thought you were going to do is not going to happen.
I think it's more, well, one, again, that we've already seen the change because I believe they're having Apollo remove their name from the fund, but I think it's just more around disclosures and letting investors know exactly Apollo's role in this on a day-to-day basis, how they're providing bids, how often they're providing bids, how the private credit's being valued on a daily basis.
Right.
As long as all that's properly disclosed, so I, as an investor, can go into the prospectus and say, okay, this is how they're doing things. You and I talked about this a little bit last week. I tend to be, pretty free market. I'm open to those things as long as investors have what they need. And I can't talk out of both sides because I've been a proponent of allowing things like Bitcoin and Ether ETFs to come to market.
Yeah.
Right. And so I like the idea of ETFs opening up access to new asset classes. I just think that people need to understand the potential limitations behind the scenes. And more from an investment standpoint, I'm not here to make any sort of investment recommendations, but I will say I'm just not sure the average investor needs private credit in their portfolio.
I don't think so.
I just don't.
The average investor really fully even understands what that would mean.
I agree. But I can make the case now that it's that area is a bit inflated. That's neither here nor there. Is this something that, ma and pa investor should be dabbling in? I would say probably not.
Probably not. I wouldn't. I always just think of me and my friends. Like, what would we be interested in? What would we need? We don't need this.
So you're not buying PRIV or PRIV or PRIV at 2 a.m.
I'm not here to, slam PRIV, PRIV at all. It's just, again,
think about the liquidity of that at 2 a.m. if it was offered.
I will absolutely not. This is, I will say, probably not one that I'll probably be researching it at 2 a.m. tonight. I probably will. I probably will start researching it. So who knows? Maybe I will buy it at 2 a.m. one day. We're going to see. All right. Last thing we're going to chat, just this tiny little thing, this little blip that's impacting markets right now. It's called the trade war. You seem to think, I think it's a much bigger deal than you do. You kind of are like, you always, every time I mention trade war or tariffs to you, you just kind of give me a collective, the shrug emoji is what you tend to give me. I have to know why, because okay, so here's my thing, right? We've already seen historically, and I don't even want to mean historically how trade wars have been, right? I'm just going to go back to the last trade war, if we want to call it that, that we had with the current president that we have, right? It wasn't great for markets. It really wasn't. I mean, every single time there was a tweet or a headline, and at the time, right, it was just China and the US. We've now introduced more players onto this chessboard. Markets responded to the downside every single time. Every single time. It wasn't great. We then continued that into the most recent, the Biden administration. We continued that trade war. They kept it going. For anyone who thinks they didn't, they did. They kept it going. And now we are, as the youth say, standing on business, and we are doubly and tripling down on this. And now we've added in Canada and Mexico into the mix. And our two biggest trading partners have said, nice try. We're going to be throwing these tariffs right back at you. And guess what? Markets are right now flirting with correction territory. Here's the thing, and why I think it's such a big deal. Again, 4 years we dealt with this, or however many, 3+ years that we dealt with this. Markets didn't love this. This touches almost every single industry. And if not a specific industry that you're kind of worried about or thinking about, at least broad markets in general. So all your broad market funds are definitely going to be impacted. They are definitely today. If you're invested in machinery or autos, real estate, if you're invested in some of these commodities, medicine, and you are specifically invested in those funds, you are going to be impacted. It seems to the downside, at least for right now. Who knows? I don't have a crystal ball. So I have to know why you don't care.
You know what's funny here is as you said all that, I think you kind of stole my thunder, believe it or not. I think we're actually more aligned on this than you might think. I think this is all short-term noise, and that it's not really investable for longer-term investors for the reasons you just said. We get these tweets and headlines every day. And the way I would frame this is, and this is not any sort of political statement, but we don't know what we're going to get from President Trump from one day to the next, right? We've already seen with how he's handled the tariff negotiations and other matters so far. And I'm not saying that's good or bad. What I'm saying is it's very difficult to make investment decisions based on what Trump or anybody in the administration may do on any given day, right? Or what they may not do. We can wake up tomorrow and, poof, the tariffs are gone, right? We just don't know.
So your point isn't that it's not necessarily that it's bad or not great, right? Because obviously the markets are down, so that's not great, right? But it's more that you cannot work around it or control it or even come up with a cogent strategic strategy in your investment portfolio. So you're just going to have to ride the wave.
100%. And this is actually
deal with it, grit your teeth and ride the wave that we're on. We're all on this train, and we're just going to have to take it to whatever destination we go to.
You know what? I love that you're bringing this up as our last topic, because it's a perfect bookend to where we started with the strategic crypto reserve, and that you talked about what Bitcoin prices did and other crypto prices, right? They bounce, Bitcoin's up 10,000, down 10,000 based on a couple of posts that come out from Trump. You just don't know what you're going to get. And because of that, I don't think it's investable. I think you have to think longer term. It's really that simple. And I know that's kind of the boring answer, but literally, I don't know what's going to happen when I wake up tomorrow. I mean, I don't anyway, but I really don't know.
So then here's the question. I think the last question that I think would be good for us to kind of end on this note, because I do like how you're thinking about it, right? Which is I could be the one that's like Chicken Little running around saying that the sky is falling. For the millennials and olders, you'll know what that is. Anyone Gen Z, you probably don't know who Chicken Little is, but that's neither here nor there. But I could do that, or I could just say, to your point, I don't know what's going to happen, so why am I going to bother stressing myself out about it? It is what it is. So then the question is, while you cannot invest around it, how do you protect yourself against the volatility that occurs?
Maybe it's buffer ETFs.
Is it buffered ETFs? What do you do then? Is it the defined outcome? What do we do then? What then is the answer so that you don't freak out so much every time you see that?
So did you just make the case for Chicken Littles to invest in buffers? I think you just made the case.
I love a good callback. I love a good callback. But really, if it's not buffers, what is it? Or is it? Is that the answer?
It might be.
If I
Again,
think
you know, I'm a long-term investor, so I always think the right answer is to build a portfolio that makes sense for you, that has the amount of risk you can stomach, and let it do its work over the long period of time.
look
And
past.
not you can dollar cost average in at 1 or 2 in the morning, but that's all you should be doing.
So, all right.
It-
So
it-
remember, everyone, looking past 4 years, and maybe that's the time for your buffered ETFs. All right. Well, that seems like a good place to end. Nate, president of ETF Store, thanks as always for chatting with me, arguing with me, laughing with me
so
for
much fun.
an episode of ETF Pulse. We'll catch you guys next week.